Hey traders, welcome to this video. Will Sebastian, Pro Multi-Asset Day Trader here. I did a stream on TradingView this morning. Don't forget to check it out. Also, if you want to trade with myself and another professional every single day live on charts, as we will be just before Fed and during it, go underneath this video, the link's there. So what did we see recently? Well, I mentioned about profit taking on various streams. I did say, we were reaching a key fib zone higher up, and remember, I use Fibonacci zones to gauge market value. So I'm not necessarily saying, oh, we hit this line and that line does this magic thing where it pushes price the other way. You got to understand that 78.6%, okay, as a fib on this previous move is pretty much representing to you reasonable investor value. So it's quite likely the case everyone who held it through the crypto winter and had it long use that price, many investors, to say, okay, well, that's fair. We will take our gains and we'll put them in the bank. Because you've got to remember that there has to be a point where, those larger investors and professional traders alike want to exit for gains. Because if they never kill their trade, of course, as you know, they're never going to make any money. So this came about also in line with a mixed bag of sentiment on US news, changing and trimming rate cut bets. Of course, what was fueling the rise in crypto assets and different index markets, for example, European ones and US ones like the SPX, the Nasdaq, the Dow, is the risk on markets. The idea that things are better than were expected, there might be a soft landing, and therefore you get investor confidence. When investor confidence goes into a HVA like this, high volatility asset, you get those extreme rises. Now, that's why using Fibonacci levels as a scale is really, really handy, because it's telling you the value of the investment all the way through. So you can see 23.6, okay, this one over here, represents very early on, not enormous value, so you don't get much liquidation. You only get a little bit tentatively. And as time goes on and the investor confidence grows, you get higher and higher up the scale until ultimately you get to this high 78.6 level. And then you get the liquidation. It could have come at 100%, 88.6, could have come beyond the high. But one thing for sure is that the longer this goes on, as I've said for so long, I said it about taking gains on this, and you'd be far better off if you did that now. Like I said, there's going to be a time when the plug is pulled and the money comes, into the accounts of those who are on the right end. And then, of course, the reinvestment comes in on alternative fib levels on the fall. So that's really where we're going to find ourselves right now, because that wick you can see visible on your daily, your weekly, your 4-hour, etc., is showing you there was a floor for price there. It's saying this is where your long side orders went in, and those newfound short side orders you saw up here have been liquidated. People have exited them. So it gives you a good gauge. Now, that was ideal for longs because of the following. If you pull your Eclipse out like I have, if you look over there, there's key price action weekly there. These are all what we call flip zone areas, technical price action areas, areas of rejection. And it's just basically, like I said, where you get those flips in price from falling to rising and rising to falling. And always, nearly always, these areas also coincide with various candle wicks, or not too many candle wicks. But the candle wicks essentially are telling you, like they did at the top, where the train stops. Okay, essentially where is the nearest point where these orders have gone into the market or they've gone out of the market. Okay, you can see coinciding with the level you fell from here is all of this price action as well. So using wicks, as long as you know how with correct risk management, is really good for a gauge for entry and exit zones, as proven. So it's going to be, we've got Fed later. If it becomes a case that there's more positive rhetoric, you may see a rise in risk on assets. You may see a further bounce up here. If it's really positive, you might rip through to the highs to 100% fib. On the other hand, if it becomes the case that there's a slight more tentative approach, you may see crypto assets fall further. Now, you've got key support down here. I think this level is very ideal for rescaling longs because it comes in line with your earliest key moving averages, telling you where the mean is of price or where a fair deal is, essentially. And of course, you've got various scaling levels represented by candle wicks to the left-hand side. Okay, and like I said, you can see these. So it's not really a good idea to slam everything you've got in. I would say, it would be wise perhaps to slowly invest if you want to. If you don't trade crypto particularly the most, that's fine. But you'll probably find you get a better aggregate of price as we fall to further flip zones or further key price action zones wherever they lie. So if you wanted to buy, you're probably a bit too late. I wouldn't gamble on the news. If you come lower, I'd get long, essentially. Thanks for watching, guys. Hope that helps. Don't forget, I'm live every single day for about 12 and a half hours a week with another pro trader. You can get it underneath. See you soon.